Welcome everyone to the first international episode of Personal Trader. For those who are following me from the Italian side of the podcast, this one will be a bit different from the usual ones. The first one with video and the first one with a guest. We are both in the Netherlands now, but we're connecting digitally. And my guest for today will be Rene Noteborn. He's a former colleague of mine from Euronext, and we've been working together in the realm of options. So that's something really peculiar that for my Italian friends from the Italian podcast, we still have not introduced. But for the new friends coming internationally to the podcast, it'll be a topic that we will talk about for many, many episodes because it's a really interesting topic. And we'll talk about many other market phenomena and so on and so forth. So let's give a bit of time to Rene to introduce himself and tell us what he's been doing the past years and what's his view of the market.
Yeah, thank you, Alessandro. Good to see you. Happy to see you. Yeah, short introduction about myself. Obviously, we know each other from Euronext, our time there, where we watch the markets mainly in derivatives. So I would say that's kind of my expertise as well. I like to tinker a lot with computers, so that kind of got me sucked into programming and all of that. At the moment, I work at the BNG Bank, and we are a bank who provide loans to municipalities and non-public institutions. And there we are currently making sure that all of the data products that they need work well. And obviously, privately as a person, I'm focused a lot on crypto. I think it's a very interesting space. I think there is a lot of overlap between them. So I think we have a lot of ground to cover here today.
Exactly. So many times, we talk about Euronext. What is this? This is basically, we can call it the European exchange. Many times people think about the exchange as kind of like a marketplace where buyer and seller kind of meet. That's historically true. But as you said, like you have most of a tech background. So effectively, that's the place. If you forget about like how it is in the textbook, how would you think about the markets now? How are they different from like how they were years ago? How we've seen them like in movies, like trading places, for instance, where people were screaming inside of it. So through the years, they have changed. And like what's the deal with like the markets now? How do they look like now?
Yeah. Well, when you look at the movies, right, then you see a lot of people screaming, pushing, shouting, being busy on the phone, right? And that's how we kind of imagine these kind of places. But actually, these days, everything is electronically. So all of your orders, they're aggregated. And then at some point, in the end, they come at the exchange where they find either a buyer or a seller to match you against. I think what a lot of people don't really see these days is that even before that, before all of that happens, right, your bank might have like a systematic internalizer. So internalizing client order flow and only sending the net aggregate of the orders to the exchange. So there is a lot of decentralization, sort of say you have a lot of different trading venues at which a price can form. And that's important to know.
Yeah, exactly. So you have a lot of these elements. It's much more complicated than people may think about. So today's episode, we wanted to talk about something in a sense easy and common. What people know, it's like, most of the times people know about betting. They tend to see the markets as somewhere where you bet. At least that's the Italian view of the thing. Trading in the stock market itself is seen as like kind of like betting for the most. And we wanted to kind of like talk about a really peculiar thing. So there are these things in the markets that are called options. We mentioned that many times, and that's what we were doing at Euronext. We were dealing with the options market there. And these options, for those that are like super, super early beginners, these are like really special products that give you a reward, if you think about it, kind of like a bet, and you pay a certain amount. So like a lotto ticket. Many of those can be seen as a lotto tickets. You buy this amount, and then if the outcome that you want to happens, then you get your reward. Effectively, we've seen now many of other markets, because as Rene said, now we have the Euronext, we have different venues, but there is the emergence of new markets, new betting markets in the US, and they can be similar to option. When we say something like that, we mean that they have some similarities in behavior. So the bets can be made really similar, modeled as option. And that's a really interesting thing, right? What do you think about it, Rene?
Yeah, I think that's absolutely true. For example, I don't know if we should touch on this now already, but there is a platform, you have these kind of crypto platforms, right, which allow you to say whether a specific event will take place. Let's say Bitcoin between, for example, today and next 30 days will hit a certain amount, and then you can bet yes or no, right? And there are many of these kind of bets that you can make, and basically they behave as an option as well. You can think about it as a coin flip, right? Either you toss a coin, if it comes up heads you win, if it goes tails you lose. And so then the question is, what would you pay for that bet? Well, that depends on how often you play, right? So if you just, let's imagine you win $1 when it comes up heads and zero when it comes up tails, well, the payoff is 50 cents. But what happens if we play that game over and over and over and over? Basically, this is an option, right? The more that you play it, that will be the time to your expiry, and then the amounts of different outcomes that you will have will basically be the probability of the instrument having a value or not.
Yeah, that's something that we call value that the instrument has due to the fact that that outcome is already happening, It's called intrinsic value. So in a sense, this is like, a bit of a lesson for like the listeners. Mm-hmm. And you have this intrinsic value, and you have also this value that is depending on like, will the event happen or not? And that's basically given by what we call the volatility. So in the market, we call this thing the volatility. And if you think about it now, when we think about the coin flip example, it is easy because it has a known probability, which is like 50-50. But how about, when the option expiry, or when we're talking about the betting system, when we think about the probability of the options expiring positively for the one that bought the option, so like that they will make money. When you think about the market, we have different venues, we have different participants. How do they find out what we can get out of that betting market regarding the probability of the outcome happening? Because that's also an interesting thing. In options, we may have something really similar to assessing the probability, and that's something we're really familiar with at Euronext, right, Rene? I'm talking about the implied volatility. What's your view like on IV? How can it be linked to what we see in the betting markets, and what is it for us? So how we were using it for pricing options?
Yeah, that's a good question. So maybe let's take a step back. These when you were taught probability in school,
Yeah.
right? Your teacher might have come up with this kind of wooden plank, and the plank had this kind of triangle in it, which was made out of all these kind of pins, right? And then in the top there would be some small kind of iron balls, and then the teacher would flip it, and then the balls would find their way through that grid, and then at the bottom you would get something that would look like a normal distribution, basically, right? And that wouldn't matter how often you did that same distribution would kind of come out the same way. Well, this kind of principle also applies for options. They are not normally distributed, but think about that grid through which they fall, right? That's basically how an option forms its price. If you start at the top, right, then that marble has the opportunity to either reach far right or the far left of that grid. However, in order to do so, the marble needs to fall every time to the right-hand side or every time to the left-hand side. And you may ask yourself, how probable is that? And this is what we mean with implied volatility, right? The larger my grid is, right, the more probable it will be that one of these marbles reaches left end or right end, right? It has a bit of a wider span that it can cover. And this is kind of what we can think about when we talk about volatility. If we have a big grid, we have high volatility, which means that the prices can fluctuate a lot, or we have a small grid, and then the probability of the price reaching a far end or another extreme is not there.
It has a lot to do with statistics. Actually, fun fact, that same thing that Rene just referred to and you were referring to is actually there's one kind of betting sites that is all based on that game. Obviously, as you can imagine, to the more savvy listeners here, when you're betting it on the website, that outcome is not going to have a normal distribution, so it's going to be a bit manipulated on the betting sites. And because that's how you have natural events, and like most of natural events, and distribution of hate, distribution of weight, distribution of IQ tend to be close to normally distributed. That's what we mean with the normal distribution. This is like a statistical event. And in the same way, the falling of the ball is falling down to the to kind of like follow a normal distribution. So that's kind of like to introduce what this game is to the more beginning listener. And in a sense, it is not the IV or this kind of like behavior. It is not really 100% sure forecast, right? Like the price of the option that we take. Many people are like, okay, I can take the probability that the event is gonna, happen based on the price of the option. What do you think about that? That's kind of like wrong because sometimes the price can be wrong.
Yeah, it depends what we look at. I think.
Yeah.
So the option has multiple components, right? So we have a couple of things that the option is based on. So the first thing is the intrinsical value, right, which represents the value of the stock that is already priced in to that option. Then we have an interest rate component, right? Because options have a time to maturity for which interest rate compensation may happen. And there might be some dividend priced in as well. Because if we have an option and we can buy an instrument in like a month, right? And in between that time span, there is a dividend payment from the stock. As an option holder, we are not entitled to it. So we need to discount that out of the price. And then the last component, right? So this way you can isolate the price that you pay for the volatility only, right? So you subtract the intrinsical value, you subtract the interest rate, you subtract the dividend, right? And then we're left with the volatility premium. And so here there's a lot of debate on what the actual volatility is, right? So we have a couple of things. We have the volatility that we can observe in the market by taking the prices, looking at those volatility components, and then calculating the probability that is implied in that price. And then we have the volatility that is actually realized in the underlying asset. And here, basically what we see is the implied volatility usually is higher than the realized price. And professional parties, they kind of try to benefit from that difference by selling the options to investors and then buying the underlying stock or index or whatever the option is subjective to, and then holding that package over time, and then trying to capture the difference in implied volatility versus realized volatility.
So that's kind of like something that we've seen many times, and most of like the participants, or at least in the institutional part of like the markets, they tend to view the options as a play on the volatility. So a way to trade volatility, if you think about it, because many times you see on these, there are like boards like Reddit, you see, Wall Street Bets, you see all these boards, and they view options as something like directional. They can obviously use it directionally, but the way more savvy players use it to trade the IV versus the RV, so the implied volatility versus the realized volatility of the outcome, which is a different game because if you think about it, when you're betting on the direction, that has to go towards your direction in a certain speed. But that's a really interesting point actually, that you just made, the difference between the IV and the RV and the realized volatility, which is actually the volatility that the underlying, which is actually the stock, and just like explaining it for listeners, is gonna have actually in the future with respect to the one that the options, let's say, thought that it was gonna have. The difference
Yeah.
between I bet that it's gonna move that X amount and it's actually gonna move that X amount. Another way I think the listeners could be viewing these, and sometimes they view options other than a bet, is an insurance. If you think about it, it could be also like a
Yeah.
form of
Yeah.
insurance.
I think it depends how
Yeah.
which type of investor that you are. So what we just described is a typical behavior for a market maker, right? And these are people, usually companies, who are 24/7. They are always present in the market. They have huge amount of capital, and they go across the world to, well, basically hire all of the most talented people to work for them. They are like, the Formula One of the trading sport, right? And then you can use options in different ways as well, right? So we can think about hedging the risk on the position that you might have as an investor. So let's say that I own a specific number of stocks, and then I am worried about that the stock price will drop whilst I go on holiday. And so what I would like to do is I would like to buy some insurance for the time that I am taking my holidays. I don't have to look at my portfolio, and then I can sleep well still. I might pay a premium for that, and then in return, I have a nice holiday. Let's put it like this. And we can do this two directions, right? So we can buy an insurance that a stock shoots up, or we can buy an insurance that a stock falls down. Yeah, I think that's the way basically that a lot of retailers, private investors might use it. Another nice thing to do with options, for example, might be, let's say that we have a stock which typically is kind of flat. So we like the company. However, the company is very steady. There's not a lot of growth, but they make a steady profit. So think about energy companies, which normally range flat, or companies who are typically in like the food industry or something like this. And then what you might want to do is you might want to say like, hey, I want to buy this stock because maybe they pay a lot of dividends, and maybe because they're just a steady, well-established company. But I would like to have a discount to my buying price. So what we can do is we can then sell that insurance to whoever is taking their holidays and doesn't want to look at their portfolio, and then we collect a bit of premium, right? So now we have gained the premium, and let's say that the stock will actually take a drop. And here there is a bit of a nuance, right? Like if you have a stock which is trading at 30 and the company goes bankrupt, it goes to zero, you end up buying this company for maybe, well, what is it? 29, 28, right? That's a bad scenario. But let's say that the company just is ranging a bit. You've sold the put option, you collected a $1 premium, and then the value of that stock moves to, like, let's say 28, 27 and a half, and then comes back, right? Then you've pocketed that $1. You've got the stocks that you liked at the price that you wanted, and now you basically own the stock at a discount.
Yeah, yeah, but that's a play that you have to be a bit more sophisticated to play,
Yeah.
because what we just described is the assignment risk right before, which is well important, because as we just said, it's like it's going to be painful if you get assigned. When you sell a call, you're basically giving, in that case, a promise that when the new owner of the call, which is a contract, which is the call option, is going to be exercising the rights to use the contract, then you have to do a particular thing, like either buy or sell the stock that you have. We'll do episodes about, like, how options actually work, but that's effectively to describe that you have some players betting on the volatility game, you have some players betting on the direction, and then other ones, as Rene just said, are using the options to do a discount or to do an income. So these are like a bit more advanced plays. Now, semi-pro retail investors and like normal investors. Now, options are obviously something that normal investors should know about, but maybe they should not get into it so fast because they are so complicated. They can get burned. And what's something that a semi-pro retail investor that has to think about, how they can view options, what they can take out of like what is currently happening, what you're seeing in the betting market, why or is it similar to option? Like what's the final thing that we want to sum up out of what we just discussed? Yeah.
Well, I think there are a couple of things, right? So I think the first thing is you should really know how these products work before you touch them, I would say.
Yeah.
And then you have different players who all play a different role in that ecosystem. I think it's a good practice to understand what drives their profits, how they are trading, to know how your counterparty is behaving, basically. And then lastly, you can do a lot of crazy things with these products, and it all depends on how you use them, right? So if, for example, if I buy a Ferrari, right, like don't take it to a kid's playground, for example. Go to the German Autobahn,
to the mountainside,
circuit, And the last thing, and maybe that's an interesting one as well, for the reader or the listeners at home when they want to practice something. What we see in betting markets a lot is that like there's some informed players and there's some less informed players. So we call them sharps and the squares. And well, basically what we've seen, for example, I don't know which event this was again. I think it was the election with Donald Trump, where we saw that polls were kind of polling 50-50. And then we saw the betting market, poly market, who was basically pricing way different. They were pricing something like 70% for Trump or something. I don't know what it was. So from that, we can take that if people are going to have to put money on the line, then the aggregate will provide a better prediction rather than polls.
Yeah, it is not something that you can 100% be sure it's going to happen as the option or betting market are pricing it. But it's definitely a bit more accurate sometimes than the polls. That's something that has been observed multiple times.
Yeah.
That's why we see all this frenzy in the betting market, because many people are actually also using it as a source of information itself. So not only as a source of making money, but on the other side, you see people using it really as a source of information. Because I guess it all revolves around the nice concept of having skin in the game. So once they are effectively putting their money where their mouth is, it's going to kind of like increase the value of the information that you get out of it. Yeah.
100%. 100%. Yeah. And professional players also look at the skew, right, of the instrument. So if we plot all of the probabilities of the movement of options in a graph, right, then that can give us that similar information of people who are putting money on the line, which will then tell us something about how all of those people expect stock price to behave within a certain amount of time. Yeah. And I just wanted to make a short loop back to poly market because just now we've talked a lot about basically bets which involve political outcomes and crypto kind of, right? I think it's very interesting to look at those markets. Just wanted to give a very short word of caution, because what I think that I see lately is that some people are also listing bets on those platforms where they may already know more than the general public, right? So let's say that I know, let's say that we're betting on a horse race, and I know that for example, the guy who put the horseshoe on the horse's foot did a bad job. Now I'm gonna bet against that horse.
Or you just kind of know who rigged the race or
Yeah,
something like that.
indeed,
Yeah.
indeed, right. So, and that's a lot what we see as well, right? I think there are a lot of posts, for example, on Twitter where people are seeing huge amounts of bets coming into these markets,
Yeah.
and then an event happens, and then immediately it gets reversed. So an interesting one, I think, was the one where we saw that there was a speech from Donald Trump, I think, a couple of months ago, and just before that happened, the markets, they started plummeting. I think it was Bitcoin and Ethereum, right?
Yeah.
And then that speech, even though it didn't really contain the information that people had expected. So they had expected something like, oh, we're gonna do tariffs and we're gonna do, all kind of bad things, basically.
Typical Trump
Right?
stuff.
Yeah, and that was enough to just like tank the market of Bitcoin, and people make huge amounts of money with that. And then in hindsight, the meeting was about nothing. It was about, I don't even know what it was about anymore.
Yeah, in a sense, it is a game where you always have to think about it in terms of liquidity. Also, in the case that we just discussed with Rene, sometimes you have outcomes like the example of the horse race, or like less, we can call them like less liquid outcomes, or like more niche markets. You have to be careful when you get into those. If you think that you know a way to play them, just be careful, because they may have, since they have less participants, they may also have more informed participants. One normally would just say they're rigged or something like that. Sometimes it's a bit more sophisticated, or sometimes you have kind of outcomes. A rule that kind of holds is like try to stay in liquid outcomes, or the ones in which you have more players. It all goes down to kind of like
100%.
normal distribution thing that we said.
Know your market, know your players, know your counterparties,
Exactly.
know what drives them.
Exactly.
Yeah, 100%. And that's a really good point. Stick to the liquid markets, because you might just get trapped with one counterparty, right? Let's imagine that we are trading, you and I, we are doing a trade, and now Alessandro is my only counterparty. Well, tough luck on me if the price of the asset drops, right? Now, what will happen if I go to Alessandro and say like, hey, can I get out of my trade? You will probably tell me no, right?
Yeah. That's something that on certain venues happens more times that you would kind of like imagine. It would be nice for it to happen. I mean, you have like, we can do episodes about this thing. Like you have all sorts of these things happening on like less reputable forums, actually stopping certain clients from trading, or because they say kind of like they broke certain rules, and then it turns out not being true. Like you're effectively trading with a counterparty. For the Italian listeners, we have discussed this in the episode 2 about cryptos, about the risk of being on a centralized exchange versus decentralized exchange, that effectively you are trading in a venue that in certain cases can kind of like stop you from trading. So, and also the counterparty, you have risk for the counterparty. All of these things, like, the options, the bettings, most of times you have to avoid getting into the illusion that you figure that out really, really well. Because as we said before, there are players that know, first of all, they are more prepared. Second of all, they're more kind of like infrastructure, so actual tools. And third, they may be asymmetrically informed. So you may be the what it's called the dump flow, and they are what is called the toxic flow. So it's basically they are toxic in a sense that they are like really toxic to you, in a sense that they know where to place the price.
I think the difference also is if I am making a market 24/7, there is a many to one relationship going on, right? So I am having a relationship. If I am the market maker, and let's say hypothetically we have 10 investors, then I know the position of all of those 10 investors because they have come to me and then they have bought an option in this example. So I know now what the position is of 10 other people, whether they wanted to buy an option from me or whether they wanted to sell an option from me. And I can change my prices accordingly, right? Whereas Alessandro, who is being one of those 10 people, he only knows the position that he did with me
Yep.
and not the position that I did with all of the other people.
A bit maybe like for the beginners is like a bit more
Okay.
complicated to understand, but what we're trying to say here is that you have larger than other counterparties, which if they're larger, they trade with more people. So you have to think about it as a wholesale supermarkets versus smaller supermarkets. There's no example that you can make actually in the real world, but it's just like you have to think about like, these, like where you have a bigger player that is effectively trading with way more players, and he knows just by trading with more players, he knows more of the current situation. Yeah, exactly. That's also an interesting point. Yeah.
Do you think that's a fair setup then?
It is a price, let's say, a price to be paid to have a liquid market in a sense. It is better. It is better to have more market makers than less, but especially in crypto, in the centralized exchanges examples, oftentimes you have really little amount of market makers in one venue. So this is one of the risks. I think these essentially becomes a risk for those players that are a bit semi-pro retailer traders, because they want to do really smart things with like with the flow, with the order book, but then they get kind of like sacked by these single market makers that knows a bit more. Now I cannot disclose much about like this side on the crypto side, but on the traditional markets you have way more market makers. So the structure is older and it has been there for many years. It is a bit more reliable in this sense. In the crypto market, it is also, it depends on your exchange though. If it's really small, a small exchange, then you're going to have really few market makers, sometimes even just one. And that's kind of like, it is a dangerous, but I think for a really niche set of like traders, not even like the general like investor is not going to care like if he gets burned over a certain amount. But like I think obviously it is not fair, but at the same time, how can the centralized exchange or whatever attract more and more market makers? First, they have to attract the first one. I think the way you see it the most when you are a retail trader is, I think, with options. So when they're not updating the quote or something like that, you're on like on the wing side of the option. We're talking about things with really technical way for the beginners. I'm sorry about that, but like when you're like in more in liquid options, like on the wings, you may have certain behaviors from the market maker that may burn you in a sense. So
they're not, at some point they're not that much incentivized anymore to give prices. It all depends, right? So like the landscape is very tricky, right? So as an investor, you have different, I think, needs than all of the other parties want, right? So ideally, you would have one marketplace which is liquid, where all of your counterparties come to aggregate as much liquidity in a single instrument as possible. And then there are all of these other parties who have a benefit with not having a single market, but basically having a decentralized market, right? So let's say that I'm an investor bank and Alessandro's order needs to route through me, then I kind of want to keep that retail flow for myself, net all of the prices and only send whatever volume is left after netting, and then keep because basically retail prices, there is always a bit of money to be made on those, because there's latency, because there's misinformation. So that is valuable order flow. Right, so I want to keep that with myself as being an investor bank routing through to the exchange. And now there are market makers at the exchange who are competing, who, and they're competing with each other. And at one point, there are only going to be a couple of them left, basically. And they basically don't want to give their prices for free to the banks to know where to net on. So that's very difficult. And luckily, we have some financial regulation for these topics. I'm not really up to speed on how that is for crypto, but I think that would need to establish itself there as well.
They are moving towards that direction. I mean, like now in the US, there's like not effectively like into the market makers and stuff, but like there's Clarity Act ongoing, like in the US now, or like released like in June, July. In Europe, we have like MiCA, MiFID being like applied onto crypto derivatives. Like, yeah, but obviously it happens like in a slow way, and we have to think about it like
Yeah.
TradFi, traditional finance has been there for like centuries, and crypto has been here for like a decade or like a couple max,
Indeed.
not even.
Yeah.
So yeah, it's gonna take it's not gonna take maybe that much time, but it's gonna take a bit of like time, and it's like they're moving fast this year and next year for sure.
Yeah.
But the point
It
is,
needs to come with the adoption.
yeah, the point is,
And
it's always like it is. One can say like it's unfair to have the market makers knowing more. What I wanted to say is like sometimes you have to pay some price for like having the liquidity. So think about it as someone acting in like buying or selling, if you're like selling or buying on the opposite side, and then so that you can always have someone that is buying what you want to sell at any time. That's how you have to think about it. But obviously they are not someone that really actually cares where the stock is going or whatever you're selling is going, the crypto is going. They are effectively there to provide this service. Since they have a certain size, they're gonna have certain like behaviors and certain kind of like gains. This is just like I just wanted to go, like kind of cover like what the market makers do, just for the beginners that are listening. Yeah,
their costs are also way bigger. Huh? Like
Yeah.
imagine they have to pay all of these expensive people,
exactly.
all of this expensive equipment, exchange licenses, all of that. Yeah.
Yep.
And it's basically what you said earlier. It's the price that you pay for being able to kind of being able to get out of your position and
Exactly.
trade whenever you want.
I think for this first episode covering these topics, we may have covered kind of like everything that is of interest. Maybe next time it would be nice to talk about like, you know, things like the Greeks on options, the volatility surface, and, you know, all these kind of like other things. It would be interesting to see Rene also on another kind of like episode. Possibly we will do a one that is more like, you know, conversational in a sense. This felt like, you know, we kind of were going the topic in an educational way, but I wanted to do it as a first episode and kind of like also use it to introduce the Italian listener of the podcast and the first national listeners of podcast to the topic. So it is kind of structured in this way. We've seen how the options, the betting market kind of can aggregate information in a sense, how you have to be careful about that. Many things and so many other things that we can like actually cover in future. Rene has been doing this for years at Euronext. Have been seeing also the crypto side of the business too. And there are many things that we can discuss, but as a remark for the investors is always make sure you know what you're dealing with, what you're trading, and always be careful in thinking that you know the markets more than you actually may be. Actually.
And know your counterparties.
Yeah, exactly. Thanks, Rene, for having joined us today episode. And well, what can I say? I wish that we will do many other episodes and we can cover like many more topics because the listeners maybe don't know that, but there's so much more that that we can talk about effectively. Something you would like to say, kind of like in conclusion? Yeah.
No, thank you for having me, and I look forward to maybe do another one, and then maybe we can cover some other topics.
That's great. So thank you very much, everyone, for listening. Once again, Personal Trader is not only a podcast, it's also an app, and you can check it out. I'll leave the link in the description. It's going to help you with AI to understand what's your position, what are your, you know, what's your portfolio, and you know, the market universe is so complicated, so many things happening, so many news, and sometimes you need a bit of help. So I'll leave that in the description. I'm gonna say goodbye now, and we're gonna meet up on the next episode of Personal Trader.